Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. I'm very excited to be back here in studios in Florence. This won't actually be headquarters for too much longer.
No, you can't stop this gravy train, man. The growth is hitting it.
I know. So not that we don't love it here in Northern Kentucky. I still live in Northern Kentucky. That's not changing anytime soon.
Yeah.
And loved this office, this space that we've built this podcast and, this business around and in. But we're going to be moving across the river, short drive, Anderson, Ohio, on Beachmont Avenue, Mount Carmel, Tabasco Road. For those that are here in the Cincinnati area that might be familiar with that. There's the exact same company that we're in here today, CMC Properties. Yeah. They own a building, they have some space, and I'm moving over there. Mostly due to the fact that a huge majority of customers, the accountants that we work with, the estate planning office that we work with on the attorney side, they're all centrally located right there. Yeah. It's just way more convenient.
A lot more business entertainment perks in the Cincinnati. And just for, we get a lot of questions about this actually. It's like, we talk about being in Northern Kentucky all the time. And I want to reassure our listeners that it is greater Cincinnati, although I will not deny the comments that have come through that we are just two hicks in a strip mall somewhere talking about the stock market. That may or may not be true. But, when we say Northern Kentucky, it is Cincinnati to everybody up here.
Kind of, yeah, more or less. Yeah. But yeah, still going to be around in the Northern Kentucky area, no doubt.
Love it.
Still going to be taking care of all the customers out this way, and really, really do enjoy this office space. But nonetheless, I'll be moving across the river. So this is maybe not the last podcast that we do at this office, but it's certainly going to be one of the last. Which is cool, but a little sad. I'm going to miss Florence, y'all.
I mean, this is where it all started, so it's always...
Yeah, a little nostalgia.
Yeah, you're going to always remember this little cramped bedroom off the Riviera.
That's where it got started, baby.
Yeah.
And it truly has been a tremendous year, growth-wise, not just because we've been rightly positioned for all the growth that's happened this year from a performance standpoint for our customers, and they're certainly happy, and we're happy for them that we were able to deliver what a lot of people were calling for was going to be a terrible year, recession year, and all these things that didn't actually happen. And we're proud of that because we've been talking about, how we come to these conclusions based on historical data. And that's a huge reason why we do the show. Yeah. Why we get a lot of good feedback from our customers and just fans of the show in general, because they don't get a lot of that, on programs that we watch all the time, like CNBC and, Fox News and CNN. There's nothing wrong with any of those channels at all, or any other ones out there that somebody might, watch and listen to their podcast shows as well. But they tend to do a pretty bad job of giving you some historical data as to, hey, this isn't the first time that this has actually happened before. And here's like 15 other instances where this similar event happened, and here's what the outcome was. So we try to provide that here, right? And that's how I control my temperament, meaning that how I make financial decisions for customers as well as myself. And we've just really enjoyed doing this program, and this has been a great spot for us to do it in right here in Florence. But we'll still be delivering all this really cool stuff when I move over to Cincinnati anyway. So yeah, it's going to be fine.
Yeah.
So now that we got all the logistical things out of the way here regarding where we're going to be doing the podcast show, now we got to get to the actual programming itself. And what are we on? Season 3, episode
18.
18?
Yeah. This, I have to double check, but this might be the 50th Financial Shepherd podcast.
Ooh, man. We need to we should have planned for that a little bit better, like with sparklers or I don't know, something.
I figured 100 we'll knock it out the park.
Perfect. But I feel like all of season 3, maybe all 18 episodes, have been about me talking about the Fed and interest rates.
Yes, and almost all of season 2 was, is this or is this not currently a recession?
Right. Because it's the only thing, and I wish I could get off the topic, but it's the only thing that's in the headline news.
It is, and it's dominating any type of rhetoric. I feel like
you almost are forgetting that there's still a war in Ukraine.
Right.
That we got a potential, we have a strike, UAW strike. They could add more pressure. Government shutdown, oil prices spike. I mean, yes, that's in snippets of news, but the headline news is what I'm going to be spending the majority of today's podcast talking about is the Fed's comments yesterday to not increase rates, which is what we were expecting here at Shepherd Wealth Management. But the rhetoric after it And the stuff that I'm seeing here today is what I'm going to spend the time talking about. So eventually we won't be talking about this, but today you're going to get something else about the same topic.
Well, okay, I'll buckle up then. I'm in.
Because it's going to be one of those days, man. You guys got me in a mood here because of the rhetoric. So here we go. So we're going to be using some Barron stuff today. So Barron's came out with what I thought was a very good article. The title of the article today from Barron's is "The Fed's Dot Plot Told One Story, Powell Gave Us Another." And it couldn't be more true. It's the reason why I think there's so much confusion in the equity markets as well as the bond market here today. And so I'm going to be using this article as kind of like the baseline for today's podcast conversation. And then we'll get into some of the other stuff I just kind of rattled off there. You know, we got jobless claims today. We got a huge amount of investors piling into cash. We talked about that on a couple of shows ago.
Yeah.
And then all the other things that I just rattled off there. So let's jump into this. So the Fed decided yesterday at 2:00 that they were not going to increase rates. They're just going to hold them steady right where they are right now. And that was expected, right? Yeah. The market's probability of a Fed rate hike going into yesterday was like 2%. So Powell delivered what the market did expect. It's what he said after he delivered this news. So always in almost every scenario throughout this entire year and all last year, his pre-recorded message to the audience is usually very good. It's very consistent, and nobody goes nuts about whatever the remarks that are predetermined for him.
Yeah.
And then they started asking him questions, and that's where the train falls off the tracks, if you will. And that's a big reason why I wanted to do this show today. So getting right into this article from Barron's, Fed official forecast that interest rates would stay above 5%, which is where they're at right now, through the end of next year, right? So he's talking about this higher for longer, which is what he said all year long. They're saying in their dot plot, which is 19 Fed members, not all of them are voting members, but occasionally throughout the year, they'll create these dot plots or where they think interest rates are going to go or where they might need to take interest rates to achieve their goal of 2% inflation and maximum employment, which is their two primary mandates as Fed governors. So they all put their dot plots together. 7 of the 19 had dots under the Fed funds rate where it is right now. And then a lot of clusters around where we're at right now, but there were a few that were above where we're at right now. So they're kind of a little bit mixed bag of opinions about where we need to take Fed funds rate to achieve the goal of maximum employment, which we already have, and getting price stability, which is controlling inflation back down to 2%, which we're not there yet, but we're pretty dang close. And if you actually were to take an annualized metric of the last 3 inflation reports, it's actually pointing directly towards that 2% or 2.5-ish or so.
Under 3.
Under 3. However, Fed officials again forecast interest rates will stay above 5% through the end of next year. Although, while unemployment will be lower than it is right now, and economic growth will be higher than previously expected. So if you expect the economy to grow, meaning GDP is going up, and unemployment is going to be lower, but yet you're also saying that we need to keep interest rates extremely restrictive through the end of next year. Now, granted, Powell did come out and say these are just opinions of 19 individuals. This isn't like a roadmap of where the Fed's going to go.
Yeah.
But this is where all the confusion lies. And this article, I thought, did a really good job of getting into that. So I'm going to go continue back here in the article. Overall, the median forecast reflected higher monetary policy over the coming year and a more resilient economy in spite of that, which is what the first comment was about, as compared with what some softer economy that officials envisioned in June. So they thought that this year was going to be a recession year, the economy was going to weaken, earnings going to be slower. None of that happened, which is the big reason why all the people that were calling for a recession this year also did not happen. So we've effectively achieved so far this soft landing narrative where we've seen inflation come down without seeing a bunch of jobs just disappear.
Right.
So that's great.
Yeah.
They're getting what they're trying to achieve, which is we're not going to break up this great economy just to get inflation back down to 2%. However, the latest SEP, which is the dot plot, outlined what Bank of America economists called a no landing scenario. And what they mean by that is essentially no price to pay in terms of growth or jobs for bringing inflation back down to target. So I think that that's a pretty fair and accurate assessment. If you're going to keep rates where they're at right now, but you're still calling for better economic growth next year, and we don't expect unemployment to spike. They're actually expecting it to go down from where it is right now, which is still under 4%. Those are all really good things. Now, Fed Chair Jerome Powell decided to focus instead on central banks' dependency on data and eagerness to proceed carefully as it decides whether and when to raise interest rates again. So I think I lost track. I had my Fed bingo card out. He used the word carefully at least 5 times. It might have been more than that. And he wanted to focus on the fact that they are in a position, I think his actual words are right here, quote, "We've covered a lot of ground," says Fed Chair Powell, "and the full effects of our tightening have yet to be felt. Looking ahead, we're in a position to proceed carefully and determine the extent of additional policy firming that may be appropriate." So he's basically saying, I'm going to let the data roll out. We're going to meet again in November and December. And if the data keeps coming in the way it has over the past 3 inflation prints, then we'll see. We might not have to do anything. But if they come in hotter than expected, then we might have to increase rates one more time. So that's a lot of mixed signaling. He's not giving us a clear answer here. And what I thought was, in my opinion, the most frustrating part of the entire presentation that he did for the whole world is he was asked directly, one of the reporters, which I thought was a great question. He was like, "Hey, I'm surprised that you're saying that we need to keep interest rates this high going all the way through next year if you're calling for unemployment to fall and economic growth to be stronger than everybody expected next year."
Right.
So the reporter asked, so your baseline case is a soft landing scenario. Well, Powell declined to call a soft landing scenario his base case, and he acknowledged what he called a long list of external factors causing significant uncertainty that could serve to weaken the economy right now, ranging from auto worker strikes, a potential looming government shutdown, to the resumption of student loan payments and rising oil prices. So this is my problem, right? If this guy, Powell, who's admitting that the goal is soft landing, why is that not now your baseline case if your prediction as a group of Fed officials is better economic activity next year and even lower unemployment? Like, how could you sit there and say that, but then not call your baseline case a soft landing, even though you're telling everyone we're trying to achieve our goal of getting inflation back under our target, 2%, while not destroying jobs? That's soft landing. That is the definition of soft landing.
Yeah.
Hence the confusion, right? You just don't know now. I want them to be data dependent. I think that's the right approach. I think that he did say some important things here about being careful. They're in a good position to not necessarily have to force interest rate hikes. They can literally sit back and wait for the data to come to them. And if it comes in like it has in the past, we should be okay as far as no more interest rate hikes this year. And we just kind of stay right where we're at on the Fed funds rate. And that's my expectation. My expectation going out through the rest of this year is that we do not have any more interest rate hikes, because I do believe that the data is going to, in fact, continue to show that inflation is softening, which is exactly why we're positioning our customers the way that we have the entire year long. We've been overweight technology, overweight industrials, and for the most part, overweight energy. It's been a really good run, if you will, for our customers. I expect that to continue. But the fact that this market, you could say whatever, we can get into all these other topics, UAW strikes, rising oil prices, resumption of student loan debt. None of that stuff is even close to what the actual risk of the market is. The risk of the market is simply this. You either believe inflation's under control or you don't. And if you believe it's under control, like I do, then hence the positioning that we have. We're very much bullish on equities, specifically in those 3 sectors. If you believe inflation is going to continue to rear its ugly head, then you want to do the exact opposite of that. You want to go extremely defensive, just like the positioning was for last year. Energy really worked. Healthcare really worked. Staples, utilities, all those things are defensive investment sectors effectively. And that worked out well last year, even though the S&P 500 was down 20% and the NASDAQ was down more than 30% in 2022. So that's really the call, is the Fed is either going to see inflation weakening, hence probably no more interest rate hikes this year, likely to hold rates right where they're at. And that would mean that the current 10-year, the 2-year, the entire yield curve would start to fall. They've been rising, and that's been a big reason why the stock market is taking it right on the chin here today, being down about 1% on the S&P 500 as I'm talking. It's just a lot of confusion. And there's very little, in my opinion, leadership, because you're saying one thing, but you're doing something else kind of all at the same time, potentially keeping rates.
And you're saying the other thing too.
Exactly.
You know, like
it's extremely frustrating. And that's actually what Mohamed Alarian, he's a chief economist advisor for Allianz, he's a president of Queen's College at the University of Cambridge, said this after the announcement. He was on, I think, CNBC or CNN when he said this. Quote, he's worried that the economic policy signals from the press conference were coming across as both confused and confusing. I don't know a lot about Mohamed Alarian, but what I do know is this guy's got, every degree, every, position of experience across economics and finance that you can find. Again, he's the chief economic advisor at Allianz, huge company. He's also the president of Queen's College, University of Cambridge. Pretty smart people there. So I'm not saying that what he says is gospel by any means. I think that there's been a lot of things that he's said in the past regarding rates and the economy that I just thought were wrong, and he was actually wrong. But in this scenario, I think he's spot on. I think the right phrasing is everybody's confused, and what Powell said was very confusing.
Yeah. I think you hit it on the chin when you hit the nail on the head, I should say. We're going to reserve the take it on the chin for the state of the stock market. That's but the leadership is what's causing all this confusion.
Correct.
It's just flat out what he's saying. It's almost like he knows that he can do that and he can keep things like they are now. So instead of showing a more robust growth, instead of sowing investor confidence, he's just going to ruin it on purpose. That's
so I'm going right there as, I don't know if you read this article or not, but that's the very next part of this article here in Barron. So the mixed messaging could have been by design.
Yeah.
A way to keep financial conditions restrictive and drive home the fact that rates were very tight, might be headed, quote, higher for longer, without promising that another rate hike this year is set in stone. So it could have been very well by design. And if that's the case, that's a shrewd dude right there, man.
Yeah, shrewd is a nice word. There's a lot of other stuff I'd tee up.
Yeah, I mean, I don't think that that's the case, just because I don't know Jerome Powell at all. Never met the man. Love to, by the way. Everyone would come out to Florence.
I mean, yeah, that whole thing about who would you invite to dinner if you could? I mean, Jerome Powell and the devil are right at the top of the list for me. It's just as long as we're just talking and eating, that's who I want to talk to.
I'd have a hard time thinking that he would strategically plan this confusing message the way that he did. Maybe he did. Like I said, that'd be a shrewd thing to do. I truly believe it's more about their credibility, as much as it irks me to say that, because who gives a damn about their credibility? You get credibility by doing your job really well over a long period of time.
Win.
Just like every other freaking person that has to get up and go to work. The reason why I say that is because they were completely wrong about inflation, being transitory. Right.
Yeah.
Now, I get the supply shocks with the pandemic, and it was unprecedented events. That's the really only thing that I can point to in history, or certainly in my entire lifetime as just being a human being on this planet. There's never been another event like the global pandemic where we shut down the whole world effectively.
Yeah, no, especially not in the context of how the globalization that we have now, how interconnected everyone is.
Right.
That's not ever happened. I mean, we've had the bubonic plague and the Spanish flu. Those things were global events, but nations were more isolated. Economies weren't as intertwined. Things like,
Yeah, that was well over 100 plus years ago.
Yeah, 100%.
Yeah. So there's not really a precedent for that we can compare it to. So I give them all the grace in the world by doing what they did, to make sure that Americans and the economy was able to get through all that. And that caused printing a lot of money and all that sort of stuff. Now, the thing is the Fed's been wrong a lot. So I'm getting back to the same Barron's article here, quote, this is the same Fed that in 2000 told us we were just experiencing an inventory unwind, meaning the housing market. And same thing.
That's our band name. Online.
And in 2007, the housing prices never go down nationwide, and that the problems in subprime would be contained. That didn't happen.
No.
In 2009, this is the same Fed that said that there were economic green shoots everywhere. And in 2018, same Fed that we were going to have to see the Fed funds go deep into restrictive terrain. So they started to jack lower rates in 2018, caused a big problem. They started cutting immediately after that. And then in 2021, this is the same Fed that rates were going to stay at zero for years to come, and then inflation was transitory. And now in 2023, the mantra is higher for longer. Sometimes it does pay to bet against the Fed rhetoric and its forecast, this author said, and sometimes, and something tells me that this is where we are today. I completely agree with the author.
Wow.
I'll just quote him again. Quote, sometimes it does pay to bet against the Fed rhetoric and its forecast, and something tells me that this is where we're at today. I completely agree with that because the focus is strictly square on where the interest rates are on the 2-year and the 10-year. That yield curve, going up causes the U.S. dollar to spike a little bit here, and that's putting a ton of pressure on risk assets. It's simply, math. If the discount rate, the Fed funds rate, is over 5 to 5.25%, and the potential for that to stay that way and maybe higher between now and not just the rest of this year, but all of next year, because the market's actually pricing in some cuts in 2024. So if we're looking at cuts in 2024, now your discount rate's coming down, which means all the yield on the 2 and the 10, the 30, the whole yield curve would start to come down. And that's a huge tailwind for equities. That's what I'm counting on, is the actual probability of a rate hike in November and December to go to zero. Now that actually did come down. I'm looking for the number here. Here it is. So as of Wednesday evening, markets were pricing in a 28% chance of a rate hike in November, which was slightly below the 29% chance investors saw a day earlier, and significantly below the 41% they saw a week earlier. So essentially, the probability of a rate hike going to happen in November has been falling every single week leading up to Powell's press conference, and that hasn't changed. So that's good news. I don't know why that's not talked about all that much. The probability of a December hike, I think, is still right around 50-50, right? So there's just a lot of anxiousness going on in the market because they're just confused as to what the Fed is saying and what they're actually doing. Because again, they're calling for unemployment to fall, GDP to continue to increase, but they're still wanting to keep interest rates extremely elevated, which would tell investors that they think that we can get unemployment low and GDP to grow, but we don't necessarily believe that we're going to get inflation under control at the same time while all this other stuff is happening. That's very confusing for the general person. And quite frankly, for someone that does this for a living, it makes me a little confused. Now, I just think this is a lot of rhetoric. And when we go back at the history of the Fed, I just rattled off, basically from 2000 all the way to now, some very important moments where the Fed's supposed to step up, maybe see things a little differently than the general public does. But I think that he's using these words and phrases and somewhat, not somewhat, but straight out confusion as a way to protect the Fed's credibility in the sense that we just left all options open on the table, right? We can cut. If the economic data comes in soft, we can raise. And we're really just not going to give you really any indication as to what we want to have happen. And matter of fact, even though we say that our goal is a soft landing, that's not going to be our baseline case. Like, come on.
Yeah, that just blows my mind because that's like, how is that different from any other day? It's like, well, it either will or it won't. You're like, yeah, no kidding, buddy.
Yeah. Just shoot us straight here.
But how about some leadership,
That's really my point about this whole thing that irks me to no end is the fact that you just can't say this is the goal and this is what we want to have happen. We're not sure. We've done a lot of tightening. It's unprecedented kind of tightening. Inflation's been coming down. We'd like to see that continue. It's still a little far away from our 2% goal, but we want this to happen. And the only way that we want to increase rates any further from where we're at today is if inflation continues to increase. And we're going to look through this oil stuff, this price shock in oil, because let's be honest here, unless Saudi decides to start taking phone calls from the Federal Reserve, the Fed can't do a damn thing about the price of oil. That's a supply and demand thing.
Yeah.
Guess who's got all the supply? They do.
OPEC.
So you can raise rates, you can cut rates, you can do whatever you want to do with rates. It has nothing to do with the price of oil. And he's so much admitted that in pretty much all of his press conferences. That's why they kind of look at what they call super core inflation, where they're stripping out the volatile energy prices as well as food prices. So they kind of look through some of that.
Yeah.
But the only reason why the headline inflation would spike is due to energy prices, going up. But it's also seasonal, right? We just kind of got through all the seasonalities of travel, summertime, everybody's going on vacations, whatnot. Now that school's starting back up, obviously I kind of expect oil to maybe fall a little bit from where we're at today, but it's probably going to stay elevated because, again, if you can keep supply constrained, which they can over at OPEC, that's going to keep the overall price of oil high. And we kind of talked about this last time. Like if you have a big oil field in your backyard, right? Where would you like to see the prices of oil? You'd like to see them high. It's pretty much as high as you can for as long as you can to make the maximum profit you can.
Yeah, it makes me feel good.
Yeah.
I'm making money.
You could. And that's what they're doing. So I don't think the Fed has much of anything that they can do to stop that from happening.
No, and don't we still have an embargo on Russian oil as well?
Yeah.
Which is, I'm sure Saudi's taking advantage of that, or the OPEC is at least.
Yeah, we haven't replaced our strategic reserves, petroleum reserves, which is kind of unbelievable to me because they were looking for, I think the phrase from the White House at the time was they wanted oil to be below 70 before they started to replenish it. They had like a solid window of a month and a half, 2 months or so, where that was actually the case. It was trading in the 60s to low 70s. I'm like, there's this thing called a futures market you guys could participate in to make sure that you're not paying more than what you'd like to. It's unbelievable to me. They've got a position for everything almost.
Right.
But not a position for maybe get some guys from Wall Street that have some experience with futures to make sure that we can fill up this important reserve, given that we're getting ready to go through hurricane season. I don't know, just a thought. Anyway, we did get some good news today from a jobless claim standpoint, but it's kind of one of those deals like good news is bad news sort of thing. So the Fed wants to see inflation cool. They'd like it to not destroy the job market. Although they've kind of been saying for over a year that we kind of expect some job loss in order to get to our 2% target, but that just hasn't happened.
Oh yeah. Last year they were hoping for it.
Right.
They were gross about it.
It was almost like they were rooting for it, but this just simply didn't happen just because of the strength of the economy. And that's a good thing.
That's a great thing. Americans need jobs.
Jobless claims came out today, 201,000 jobless claims. The market consensus was looking for 225,000. So lower is, to me, good. More people are at work. But in some people's eyes, that means the Fed is going to have to stay more engaged, right? Because, hey, we got too many people making money, which means they can spend that money, and we don't like that. That's dumb. That's just what the whole, U.S. economy and virtually the world economy is built around. People having jobs, they can spend money, and all that money gets trickled down into revenue, which gets reinvested and so on and so forth. That's the machine called the U.S. economy.
Yeah, and it just gets stuck at the top.
Now, even more interestingly for me, I obviously do this for a living, managing assets for customers, and I've been a certified financial planning professional for quite some time now. There is more cash sitting on the sidelines than any other point in time in recent history, even going back to 2008 and 2009, which, by the way, this is not 2008 and 2009. 2008 and 2009 was the worst thing that's ever happened. And anybody that's listening to this, it's the worst thing that's ever happened in your lifetime. Unless you were around in 1929, that was the only thing that was worse than 2008.
Yeah, this is nowhere close.
Not even close. But still, yet we have more cash. So I got some statistics here, some data for you all. Just in the past 3 weeks, $74 billion has flowed into money market funds. While equities continue to be starved of inflows, investors are sitting on a mountain of $5.6 trillion in money market cash. And this will not be reinvested into money market funds forever, right? You're not going to sit there in a money market for the end of time. So we kind of see this. First of all, the statistic is nuts. $74 billion in 3 weeks and a total of $5.6 trillion. That's not doing anything but being parked in a money market that's probably getting about 5% interest. Keep in mind, you have to leave that cash in there all 12 months to get all 5% in interest.
That's why it's still there, probably, right?
Maybe, but I think moreover, it's people are nervous about the market itself, right? Think about this, like if you're an investor that missed all the run up in the S&P, you missed all that 15 to 17% growth, or let's say you missed all the NASDAQ growth, even worse, more than 30% performance out of the NASDAQ and not even 9 months this year. If you missed all of that because you were afraid, you read all the headline news coming into the year, like this is going to be a recession, right? It was like the most predictable recession of all time in the eyes of a lot of people.
Yeah.
So they were already sitting on a ton of cash coming into this year, right? I think there was around 5 billion or close to 5 trillion sitting in cash coming into this year. Now there's even more cash on the sidelines. So if you missed all that run up and now you get the Fed coming out here yet again with all this confusing messages, people are probably just like fed up, like, hey man, I'm just going to sit this out. I'm going to sit it out. And they'll sit it out up until the point to where the Fed actually acknowledges, yeah, we got inflation under control. We don't actually need to jack up rates anymore. And then the market's going to start to look at, all right, when are you guys going to cut? Because now it makes no sense to have rates this high if inflation's low and jobs are plentiful.
Right.
And that's the tailwind for the market from a macroeconomic view. But just from a strict math point of view, if you got $5.6 trillion sitting in cash that probably missed out on all this growth, if I am right and they're not raising rates and that finally becomes the message that you hear, you're going to see this $5.6 trillion flow out of money markets in like 3 seconds. And everybody's going to be chasing the performance that they missed out on leading up to that point in time.
Yeah.
And that's kind of what I'm banking on here from an investment thesis standpoint, because the risk is not the UAW strike. At least it's not. I mean, the UAW would have to strike for a very long time to see some sort of significant impact from an economic perspective regarding GDP and all that sort of stuff. Obviously, if you strike long enough, people aren't getting paid. So that's kind of what the Fed's looking for in some respects. Now, the government shutdown thing, I know we talk about that every time on the news, and we've talked about it a couple times already. That's a self-preservation conversation, in my opinion. It shouldn't shut down. There's no reason for it. But the reality is they're going to take it all the way up till the 9th hour, right before midnight or whatever the deadline is. And hopefully they come to some sort of agreement just due to self-preservation. Like, why would anybody vote these people back in if they're just going to use the United States government shutdown as a lever that they can pull that's going to impact millions of Americans just to get their agenda across?
Yeah.
Like, you didn't get put into office for that reason, bro.
Well, they didn't get put in office. This current Congress has done nothing. And what little they have going on chasing these impeachments has to stop if they shut it down. And there's no way they're going to shut down the only thing they have going for themselves. It's just like you said, it's like they're not going to not take a paycheck.
Right.
They're too greedy.
It's self-preservation. So that's kind of my viewpoint on that.
Yeah, it happens every time. And I don't see why this would be any different.
Yeah. And the same thing, we talked about oil, but this investor piling the cash thing is this is behavioral finance in real time.
Yeah.
That's what this is. And it's fascinating to me. I feel very bad for the people sitting on $5.6 trillion worth of money markets. But we'll see what happens with that. I have my opinion, and we're either going to be right or wrong. Like I said, either you believe inflation's under control, which means no more Fed hikes, which means interest rates are going to drop, which means market rallies. The only other option is inflation is not under control. The Fed does have to raise and potentially raise again and staying very much higher for longer. And that's going to be, a punch in the gut for the stock market. You'll see rates rise, you'll see the dollar increase, and then that means the stock market will fall. There's only one of two outcomes here. I don't think there's going to be much of a middle ground as it relates to those things. And you're seeing it play out right now. You're seeing it play out in actual investor decisions to move a significant amount of money, a staggering historical amount of money into cash, while the market is actually, extremely healthy from an earnings perspective. If you look at GDP, I mean, we can sit here and go on and on about all the things that are great about the market, yet people are human beings that were hardwired with fear and greed. Going back to caveman days, 2,000 plus years of human being history, and we've hardly changed at all, right? This is the big reason why I love studying history from an economic perspective, and folks like Warren Buffett and the like, where they're basically saying, hey, the human being hasn't changed over 2,000 years. The one thing that we know for sure about human beings is they don't like to learn from history. Well, we've given a lot of historical precedents under similar circumstances that would argue against the headline news that most people are seeing. And that's why I love doing this show. That's why I love doing my job in general. And certainly I hope that this is extremely helpful for individuals out there, but it's not any more complicated than that. You either got inflation under check or you don't.
Yeah.
So that's kind of everything that we wanted to make sure that we highlighted here. As the other thing, you are seeing some stuff in the news that are pretty dumb headlines. There is one here in Barron, so I just gave you a really good Barron's article to maybe consider checking out. But I kind of look out for all this stuff because I tend to believe that this is where most people's vision goes when they see it on social media, right? This will get shared all over the place because of the clickbait sort of headline. Barron's has an article here this morning that says stocks are nosediving. Here's how far they could fall, right? And that sort of stuff is what's getting shared. There's a lot of fear going on out there. And the simple fact is, since we're hardwired with fear and greed, what we've learned from behavioral finance is that human beings feel losses twice as much as they feel good about making money, which is, again, why I love to go back to what history has to say about similar events. And all this clickbait sort of like headline stuff is out there everywhere after Fed Chair's very confusing press conference yesterday. And I can understand, the average Joe or average Sue investor that's just like getting some, news pushed out to them on their phone. And that's the kind of stuff that they're probably getting pushed on.
Oh, yeah.
And they go to Twitter and probably see a whole bunch of other very, very similar things. And then you get, what are supposed to be professionals on TV that are very likely saying, inflation's a problem, oil prices are up, all this other stuff. And the Fed's going to have to keep raising rates, and markets need to fall back down. These are probably most of the people that missed out on all the good stuff that happened so far this year because they were pounding the table saying, this is going to be a recessionary year.
Yeah, they weren't participating in reality, so now they have to try to ruin it for everybody. I mean, the headline of that article might as well be like, you're going to die in the car on the way to work today. Start being terrified now.
Right. It's like, that's what the news does, right? And I mean, you can't knock the news because they are putting some good things out there, but their job is to get your attention.
That's it. It's entertainment before it is knowledge.
Right. So I wanted to give you some good stuff in Barron's today too, now that I've, kind of turn my nose up at this one specific article here. But just keep in mind that, there's always been a historical precedent outside of the one time where we had to shut down the whole world for a global pandemic. And if you look back at what history has to say, it gives you a lot of confidence from a probability standpoint that very similar events will happen in the future. Maybe not to the day, to the hour, your perfect timing in and out of positions, but generally speaking, it gives you a pretty good indication as to where you want to be and where you don't. I think it's as simple as this. If you've missed out on all the growth this year, or if you've been like our clients that have gotten, all that growth and then some, you still have to make this decision. It's on one question. Do you feel like inflation's under control or not? If you do, like me, then you want to be positioned for growth. The sectors that are most highly correlated with easing financial conditions. That doesn't mean the Fed's cutting this year, but the market's going to look forward 6 to 9 months. So if inflation's under control, they're counting on cuts sometime around
Panama City time, baby.
Right. And hence the good things that'll happen in the market, interest rates falling across the yield curve, etc. Or I'm wrong, and inflation's a problem, and the Fed stays engaged. They increase rates and they keep them much higher for very much longer than what markets had originally anticipated. So that's the question. All this other stuff, it's some noise, right? UAW strikes, potential government shutdown, oil prices spiking temporarily. The fact of the matter is this: we're a consumption economy, and we're the world's largest economy. And as long as people have a job, which they clearly do, that spin wheel of spending will continue. That's great. We just have to make sure inflation is under control. Last three prints said that they would be. If that continues, and I think we'll get another inflation print here in the coming month, I don't know what else everybody has to complain about at that point. So it's not going to take long. It might go through some pain here through the last week of September, potentially the first part of October. But when earnings season kicks off around mid-October, and we start to continue to see the jobs information coming in the way it is, and we get some good inflation data, meaning inflation continues to fall, I think we're in a great spot here. But we'll find out very soon. And it's just a shame that we got to sit here and watch all this stuff happen in front of us while people are just piling into cash. But when they get the all is clear, it's probably going to be really late, for them to get out of their money market and then get all that money to work. And they'll probably do it gingerly and slowly until they see things ripping and roaring, and then they'll want to pile in potentially at the worst possible time. And I'm going to do what Buffett famously said to do. I will be fearful. I will be fearful when others get greedy. And right now I'm trying to be greedy when others are fearful. And the fearfulness is just freaking everywhere right now. Yeah.
Unfortunately, we might see a repeat of that crypto boom in the end of the pandemic. Everybody missed out on the earnings and they hopped in at the worst possible time and they all lost money and said it was a sham.
Yeah. Right.
And you might see that with something as reliable, or I shouldn't say as reliable, but as historically proven as the stock market. Unfortunately, people are going to hop into last minute and expect to get the returns that they missed out on.
Unfortunately, somebody sold all of their shares on March 8th, 2009. The market recovered. The start of the recovery on March 9 of 2009. So that happened. There was somebody out there that sold it all literally the day before everything started to turn around.
We'll just call them Carl.
Please
Carl,
don't be.
Call us in. Call Joshua.
Carl, it's good to see you.
Yeah, I'm here to help.
Yes.
I think, that this also, we talked about this a lot last time, but which I thought was a really great podcast, episode 17, where, you kind of drove home the point that it's okay to not have the education and the information that you need. What's not okay is to kind of like confuse yourself that you do.
Right.
That you're able to participate in something. So if you don't know how to invest your money, or if you're scared about it, if you don't call Joshua, call someone who can help you, because whatever you pay them will be 100% less than what you lose thinking that you know what you're doing when you don't.
Right. I mean,
if you don't have the education, go find someone who does to help you invest your money, because now's not the time to be sitting on it.
Yeah, we'll probably want to get into that topic in a lot more detail coming up here, as I appreciate that, because it's been on my mind. There's actually been so the company founded by John Bogle, Vanguard, probably have heard of Vanguard before.
I have, yeah.
John Bogle, rest in peace. It's a great man.
Did he make those chips that you put your fingers in? No, that's bugles.
Yes.
Sorry.
Yeah.
All right.
It's close. Bogle, Bugle, I get that.
I'm just hungry.
Yeah. So John Bogle, he created Vanguard, right? Index investing. He wrote a book called The Little Book of Investing. It's a great little book to read. And he talks about, specifically how active mutual fund managers consistently underperform the market, and they get paid, huge sums of money to, quote, try to beat the market, and their track record is terrible. So he's like, hey, if these guys can't do it, they've been trained, they have all the tools, the resources to potentially, or they should be able to consistently outperform the market way better than a retail investor. But there is all kinds of data that suggests that that's not the case for actively managed mutual funds. So yes, for the average person that wants to do zero homework and hire no one because they want to be, quote, in control of their own money, that indexing is actually a good thing. So a low cost way to invest in the market. There's nothing wrong with that for those that are out there doing that. There's nothing wrong with Vanguard. The one thing that Mr. Bogle did not point out in his little book of investing is the simple fact that mutual fund managers effectively have rules, and they can't violate these rules, meaning that they're somewhat handcuffed as to what they can invest in, what they can't invest in, how much they can invest in a certain area of the market, etc. That's not discussed at all. So that they're not giving them that handicap, right? If they're trying to outperform the market, well, they might only be able to do so much as far as overweighting technology versus any other part of the market, if you will. So that's a big reason for that. And the other part is that there have been a lot of people, Warren Buffett, Peter Lynch, and I could rattle off a whole bunch of others that have a very long track record of successfully outperforming the market. Now, the one thing about Buffett's process, which he's made very clear, if you go in my office or you go to Amazon, all the books that Warren Buffett wrote, I have them, I've read them, I've reread them, and I continue to read them. He gives you the playbook about how he created what he created at Berkshire Hathaway. And somebody asked him directly at his last shareholder meeting this year, in fact, Mr. Buffett, like you've given us kind of a blueprint here. Why aren't there so many more people and firms like following in your footsteps and doing what you've done? Mm-hmm. And Buffett very directly and instantly said they don't want to get rich slow.
Yeah.
Most of Buffett's money, the vast majority of it from a percentage standpoint, was made after he turned 60 years old.
Yeah.
And most of that outperformance that he did is everybody, in school. This is going back to grad school. This is even going back to undergrad school. Everybody in this profession, because, when I was working at Fidelity and TD Ameritrade, they just hammer down your throat. Diversification is good. Diversification. It's a good thing in theory, but Buffett said it best. The death of performance is diversification. And it's not his opinion. It's just simply math. The way that you calculate performance is you take the weighting of position 1, you multiply it by the performance of position 1. Then you add the weighting of position 2, multiply by the performance of position 2, so on and so forth. So you can easily tell if you have too many positions,
it'll cancel itself out.
Even if you have, a handful of positions that just knocked it out of the park, 200% returns like NVIDIA. Well, if you only had freaking half of 1% in that position, you didn't hardly feel the effect at all.
Yeah.
So truly the death of performance is diversification. Now, if you're not going to be diversified like an index is, right? So going back to John Bogle and Vanguard, an index is extremely diversified. S&P 500 is 500 of the biggest companies here in the United States. Very well diversified. It's going to be hard to get, an NVIDIA-like return, when you invest that way. Now, again, if you're not going to do your homework, you probably are better off doing something like that. But if you are going to be willing to do your homework, like I am here for our customers, because it is my job, I'm going to do the research, and I'm also going to look at not just the individual company, the track record of the CEO, but I want to look at what other events in the economy that have happened in the past that are very, very similar to what we're going through right now. Because again, the market's forward looking. And if you can say, hey, the market's made up of human beings and human beings tend to repeat similar events over and over again, it's thing called history. That gives you some pretty good indication of where you want to allocate more of your resources. And that's why we're very comfortable to somewhat concentrate a portfolio to maybe 20 stocks, as opposed to trying to own the whole market. So that's a way for us to get that extra, what we call alpha, meaning outperforming the S&P. And it's not anybody's opinion. It's not even Warren Buffett's opinion. It's just simply math.
Yeah.
And the fact is there's too many people like myself, with all the great intentions of the world saying that diversification is good. In fact, for a lot of people, they don't need to have that many positions. And certainly they're not looking for that level of diversification if they truly understood how to get the types of results that they're looking for. So more to come on that. I think it's a great topic for us to dive into in future podcasts.
Yeah, I agree. We could do a whole probably season on the difference, diversification and asset allocation and how
I'd love to talk about anything other than what we've had to talk about for the last.
Well, I hope you're saddled up for this election year we're about to talk about.
Yeah, I'm wrapping my mind around those right now. I'm literally already preparing for those questions. I know what's coming. I've done a few of these election cycles before.
Yeah. Well, we started the podcast pretty close to a mid-season election, didn't we?
Mid-season election stuff. And this one's going to be, it's set up for a doozy right now. So great news is Saturday Night Live episodes are going to be awesome.
Well, I've heard prisons serve pretty good food, and I'm still not really wanting to go. So that's kind of my thought about it.
That's a great way to wrap this one up, man. I appreciate all the watchers and listeners. Is there anything that we got to share with them regarding our schedule or anything like that?
I don't think so. No, there's going to be some small aesthetic changes coming.
Yep.
As we continue to evolve the podcast, the live service with the move to Cincinnati. So just bear with us. But if any major announcements, you'll know about them.
We'll keep doing this about every 2 weeks as scheduled. Don't forget to check out shepherdwm.com. You can get access to all the newsletters I've written so far this year, access to all the blogs that we try to do almost every Friday. We'll be writing one again this Friday. It'll take you right to our YouTube channel on our website, as well as Spotify for those that, want to listen to the program, whether working out or walking the dog or whatever. And we'll continue to post all that stuff out there. So we'll make that available to everyone. And of course, If you like the show, don't forget to give us a little comment, a little thumbs up, hit the notification button. We'd love to make sure that you have, the latest information from us when it becomes available. So I really appreciate that. And we'll do this again in a couple weeks. Hope you all have a great rest of your day.